What's up, everybody? It's Megan here with Student Loan Planner, senior consultant on the Student Loan Planner team, and Trump has won the presidency. So we've got to talk about what that means for public service loan forgiveness, or PSLF. Will Trump repeal the PSLF plan? Short answer is, I don't think so. I think we're safe with PSLF. This original plan, this original program was written into legislation, unlike the SAVE plan that's being contested right now and some of the plans under the ICR statute, like ICR itself and the Pay as you Earn plan. Those plans were brought about by negotiated rulemaking, executive order, not a legislative process, not votes from the Senate. So PSLF, I think, is safe and lower on the totem pole of something that the Department of Education or this new government coming into office is going to want to focus on. They're going to first want to focus on the SAVE plan, which I did a whole video on previously. Go check that out if you missed it. That's part of this whole conversation as well. But short answer for PSLF is we think it's safe at this time. Now, a couple notes, because I know there's still going to be questions about this, and since the SAVE plan is being contested and will likely get repealed, it's still going to affect our PSLF folks. So let's say you're someone who's on the SAVE plan. You have been in forbearance since probably the summer because they've been contesting this plan. There was an injunction on this plan itself, so no one has been able to make payments on the SAVE plan for a bit, which is unfortunate because the forbearance is not counting towards loan forgiveness. And that's what matters when we're making payments or when we're working towards this program is time. We want to be done as soon as possible and pay as little as possible to get there, right? So if you are someone who's in or on the SAVE plan, or let's say you're someone who tried to apply for SAVE, but you didn't make it in time before they've shut everything down and you're sitting in a forbearance period or like an administrative forbearance or a pause on your payments. If that's the case, you are ripe for going ahead and switching our plan from the SAVE plan over to the IBR plan. Income-based repayment was brought about by legislation. It was voted on. It wasn't brought about by executive order. So this plan is very safe. Now, there's two components to IBR. There's old IBR and there's new IBR. Basically, it has to do with when did you borrow your loans and what is that monthly payment going to be on IBR. The payment can either be 10% or 15% of your discretionary income. The payment can be 10% of discretionary income on IBR, called new IBR, if you are considered a new borrower as of July 1, 2014. So that means you did not have any balance outstanding as of that time, and you borrowed your first loan as of July 2014, or after July 2014. Now, you could have borrowed loans historically. Let's say you borrowed loans in 2001, but you paid off all those loans in 2005. Totally done. But then you go back to school in 2019 and you borrowed loans and you graduated in 2022. You are still considered a new borrower because those older loans were paid off before July 2014. Old IBR's longer term forgiveness timeline is 25 years. The new IBR timeline is 20 years. That shouldn't matter, though, if you're pursuing PSLF, because PSLF is 10 years if we're consecutive and consistent with our payments. These months in forbearance are not counting towards loan forgiveness, so we may as well go ahead and make a switch to the income-based repayment plan, IBR. When you make that switch, you can do this for free on the studentaid.gov website. You can apply. It'll link back to your most recently filed tax return to base the payment off of. Now, this is something to be aware of, though, because you may not have been doing some tax planning prior to this, because maybe you thought the SAVE payment was going to be low enough to where you didn't have to. And this is where tax planning might be even more important. And what I mean by that is if we're filing taxes jointly with our spouse, your payment is going to be based off of joint income, you and your spouse's income, no matter what, unless you are actively going through a divorce or you are separated. If you filed taxes separately, you can keep the payment off of just your income. So that's the difference there. Filing jointly, the payment's off of joint income. Filing separately, the payment would be based off of just your income. You may have filed jointly for 2023 if you're married. If you filed jointly, it's likely that your payment's going to be higher if you go ahead and apply for IBR now. So one thing to consider is if it doesn't make sense for you to switch to IBR now because the payment is going to be too high or because you're not going to be eligible for IBR, also because the payment's too high, you no longer have a partial financial hardship. I'll talk about that here in a second. it may make sense for you to just hang out on the save plan for now until we have to make a change and or until we can file taxes married separately for 2024. So that time is coming up. That's something that you could do, and you could go ahead and apply for the IBR plan at that point after we've got that separate return on file. Now, remember, if we hang out on save, we do get 0% interest, but those forbearance months are not counting towards loan forgiveness. So the downside to this is that we're not getting credit towards PSLF, but the positive is that we're not having to pay a really high payment if it's something that would make a big difference if we were filing separately and we just want to wait for that. One backup plan that you could have is what's called the PSLF Buyback. So let's say we're in these forbearance months, which all of us have been if we're waiting on PSLF right now, we're kind of trapped on the save plan. There is what's called the PSLF buyback program. We do not know if this is at risk. It could be. Who knows if we've got Trump in the presidency seat. But what PSLF buyback is today is basically a way to purchase months of forbearance where you didn't have to pay, but purchase those months of forbearance in the future when you're applying for loan forgiveness so your timeline isn't affected towards the PSLF program. What this looks like is when you're going and applying for PSLF, that's when you have 120 months of credit towards PSLF or 10 years, and you'd want to include the months of forbearance that are not getting counted right now. You would apply for PSLF at that time, wait for your payment counts to get updated, and then you would submit the PSLF buyback request through the PSLF reconsideration system. And basically what you're saying is, hey, I know I have these months of forbearance. I want to go ahead and purchase these months. And they will base that payment off of what the taxable income was for that year. They'll request a tax return to verify what the payment should have been, calculate that payment for you, and you pay that lump sum to be done with your PSLF journey. You can't do this unless you've already got 120 months, which the forbearance months that you're asking for count towards those 120 months. But this is a backup plan to not delay your timeline and something that hopefully we can rely on. Some important details with the PSLF buyback program that need to be noted is you cannot purchase months of forbearance before a consolidation. So lots of folks consolidated with the IDR and PSLF waivers recently. Any of that time before the consolidation cannot be part of the PSLF buyback. You can't purchase those months because you consolidated, which they're considering to be a brand new loan. Another note is that you would have 90 days to pay that lump sum once they confirm how much the buyback amount is for you. So you need to make that payment within that time period to be eligible for the loan forgiveness. All right, but what if you are someone who's on the pay plan or on IBR or ICR right now pursuing PSLF? Good news is your payments have not been affected or shouldn't have been affected like the people on Save. So you are likely still in repayment right now on one of those plans. And my advice to you right now is to stay put and continue to make payments on those plans for now. One thing to be aware of is that the ICR statute is also going to be under scrutiny, which is what the SAVE plan was derived from. It's also what the PAYE and the ICR plans were derived from. So what that means is we know SAVE is pretty much dead in the water right now. We don't know about PAYE and we don't know about ICR. Could they axe those programs or those plans as well? We don't know. If they do, you do have the option to switch over to IBR as well, income-based repayment, and it would either be the new IBR or the old IBR calculation, depending on when you borrowed your loans. But I don't think you need to make any changes or moves now because we don't know if that's going to be the case. Hopefully not. Hopefully they're not affected. But if they are, just know that we do have the backup plan of switching to IBR. One final note I'll mention about IBR is there is what's called a partial financial hardship requirement. It sounds aggressive, but it just means that to be eligible for this plan, your payment has to be calculated lower than what it would take you to pay off the loans within a 10-year time frame. So they take the balance, they amortize that over 10 years, and they calculate a payment with principal and interest. That is the standard 10-year payment cap. That is the payment cap for IBR and the pay plan. Pay cap, payment cap, that just means that if you're already on this plan, the IBR plan or the pay plan, and your income gets up to that point where it's getting higher and your payment is calculated to be over that standard 10-year payment cap, whatever that is for you, you're going to get a nastygram and it's going to say, hey, you're technically no longer eligible for this income-driven plan. But know that you do not have to make a change. You can stay on this income-driven plan and just pay that standard payment cap. It still does count towards PSLF, and it still counts towards the longer-term forgiveness as well. You don't have to make a change. And this is super important and could be super strategic or helpful for those whose incomes kind of explode later on in their PSLF journey. So if you're someone who's had a long period of training, maybe residency, maybe fellowship, and then attending salary is kicking in soon, you have that payment cap to where there's at least a ceiling for where it can't go above. So that's a good thing. But where this becomes a problem is if we're on, let's say, the pay plan, or we were on the save plan and now those plans don't exist, are we going to be eligible to switch over to the IBR plan? That's something to be cognizant of because we have to have a payment calculated lower than that standard payment cap to be eligible for IBR, to apply and to be approved for IBR. So if we're close to that standard payment cap, we may have to do some strategic planning with reducing your AGI. This is where tax planning can be really important, contributing a lot to your 401k, making sure you're maxing out HSA or FSA dependent care, anything pre-tax you can dump money into, looking at filing taxes married separately to keep the payment off of just your own income. So some of these strategies come into play, also strategies with recertification timing. When should we update our income? When should we actually file our 2024 return? Do we file on time or do we extend to October 15th? So some of that strategy comes into play to try to, one, maximize your repayment plan and save as much as we can on our payments, but also two, if we're close to not being eligible for IBR, making sure that we're eligible for IBR with some of these little levers we can pull. I hope this is helpful. PSLF, I think, is going to be safe. Hopefully, you know who needs to be making a switch over to IBR. If you're on the pay or IBR plan already or ICR, just stay put for now. We'll learn more in the future about if those plans are at risk. IBR is not going to be at risk. That plan is written into legislation. If you need help, that's what we do. This is our bread and butter. So we do one-on-one consultations if you would like some help navigating your situation, to talk through all the ways we can go about this, the best way to maximize your plan and the best way to save as much money as possible on your plan. But we also have free resources as well. We have a lot of calculators on our website you could check out, a lot of blog content, and of course these YouTube videos, and we have a podcast as well. So lean on us in this time of craziness in the student loan system. You're not alone. We're here with you, and please let us know if we can help. Until next time.